February 6, 2008, 2008 Real Estate Capital Outlook, Low Interest Rates and Funding Volume. Orlando, Florida, February 6, 2008, lenders gathered in Orlando to discuss various funding programs and the market outlook for 2008 and beyond. The take-home values of the meetings illustrate the following. Rate movements. Market sentiment appears, for the moment, to favor even deeper interest rate cuts. No one was forecasting higher rates. Regulation. More regulators are expected to audit banks and other financial institutions this year. Expect tighter underwriting and overly conservative fundings from these sources. Lower volume. Some lenders, particularly CMBS players, expect substantial volume drop, as much as 50% or more. Many life companies believe they can reach last year's target, but are concerned about relative value investing. Should lenders try to catch a falling knife, was a statement made by a life company executive. Reliability. Certainty of execution is the strongest selling point for borrowers, rather than spread or other pricing variables. Valuation. Most lenders are pegging values in the 7% or higher cap rate range. Need lots of supporting data, recent comps, to justify lower cap rates. Consolidation. Smaller life companies continue exploring outsourcing and purchasing mortgages instead of direct origination. Rejected underwriting. Interest only, except for low leverage. Cap rates below 7%, unless strong market conditions or credit tenant, cash out on cost, no borrower equity in the deal, leverage much above 75% except for apartments, comps and market data older than 6 months, vacancy calculations below market levels, very few 5% figures accepted for most commercial properties, projected cash flow modeling versus income in place. Watch list. Lodging, non-essential retail, land loans, nearly impossible without recourse, overbuilt markets, and secondary markets. Basically any properties that are not currently cash flowing and with too much story. Loan size players, $100M plus, balance sheet life companies, less than a dozen players, $10 to $30 million. Most common funding range for life companies, conduits and banks, less than $10, select life companies including small loan programs and banks. Retreating, Wall Street houses, banks and select life companies with sizable CMBS holdings, at least until more loans are removed from balance sheet. Treasury pricing, wide yield curve, depending mostly on funding source. Life company spreads vary widely from 190 to 275 bits per second. A substantial gap thereafter as Wall Street CMBS deals are priced on the high end of the curve starting at 350 bits per second over treasuries, or 290 bits per second over swaps for immediate funding loans. Fixed rate floors, 5.5% rate floor for any type of fixed rate product, regardless of term, except for agency deals. However, most deals are trading 5.75% or more, or about 6% rate for most mid-tier life companies. 3% LIBOR floor set up by lenders to protect floating rate yields. Relative value, investment alternatives such as AAA corporate debt trading at 230 to 240 bits per second, translating to about 150 basis points over comparable swaps. In a nutshell, insurance companies have this alternative, representing a 60 basis point difference for investment-grade bonds versus investment-grade real estate debt.